तो इसलिए मैं कल को रिकरेक्ट बनाया था।
वो ले लिया ना इंश्योरेंस क्या हो रहा था
Okay, let's start actually. Well, good afternoon, dear friends. On a small introduction note, this is a fantastic subject, which is a need of the day, because payment risk in export transaction and role of ECGC is such a big and responsible subject, which many of us know, but many of us don't know also the same. What is this all about? So first, let me welcome Shri Anand Singh, General Manager, Chief Marketing Officer, and he's very, very knowledgeable and a science graduate and an MBA. Joined ECGC in 1998, so he's got over 2 decades of experience. And I think we are talking and we are sitting with to hear from the right person of the total subject all about. And the next person, what we are talking about as the next speaker will be Mr. Saket Kumar, is an Assistant General Manager with ECGC in marketing. And again, he's a postgraduate of international business. And I think he has got the right experience, and I'm sure we will be able to hear what we really require. So this banking and insurance, this is a fantastic subject, and it is one of the two big pillars for our trade particularly. So this is what we all have been waiting for, because for example, we've been seeing like there are crores of rupees worth order. People start purchasing the cargo without knowing whether this buyer is genuine or not. And even people, a lot of people don't know that you have a small registration done with maybe, I think it's around 20,000 rupees to know the genuineness of the buyer. Even many people, many exporters doesn't know that this kind of beautiful, valid information is given by ECGC, which is really, certified. So this is a technical know-how which we all should know, and this can be even passed on to our clients, on which will be very, very useful for them for their future. Because today, in this current situation where we have so much of disturbances all over, and this will be the right opportunity and the right company to take up and keep everybody posted of and elaborate what ECGC is doing. So, sir, we are really happy that you have taken your time and come to us to explain what is this all about. So now we have our chairman, Mr. Shankar Shinde, a very, very experienced person in shipping, and he's leading our forum, which is a pan-India basis. We have around 24 and 29 associations, all India basis, and all custom house agents are associated to this freight forwarders association, wherein we have close to around 7,000 plus members, and we are just trying to take another 10,000 members also, which will be one of the most strong and positive association which can decide, and we only are the bridge to the exports and imports and the revenue and the forex. So we are also equally a nice forum, and we are eagerly to hear from you and take away a lot of knowledge and share this to our clients and take it further. I would request our chairman, Shankar Shinde, to give a welcome address. Thank you so much.
Thank you, Mr. Rajesh Kumarji. Thank you, Mr. Rajesh Kumarji, and thanks for that good introduction of our FFA also. Welcome, Sri Anand Singh ji and Sri Saket Kumarji. And it's nice to be associated with ECGC, because as we understand, the ECGC plays a very important role in the EXIM trade. And we, as a logistics service provider, would like to complement their services with the insurance. Like, if you talk about our industry being a logistics service provider, it becomes a very important. The perception about our industry needs to be changed. They always think that ECGC is only for the exporters or the importers and not really for the logistics service provider, which needs to be changed. And that is where our players start preparing and playing a very important role in the aspects in guiding the exporters. Having known the exporters who know about the ECGC, yes, they are on the board, but those who are not touch upon the ECGC needs to be educated, and it is our industry who has a reach to that exporters, who can really say, no, you have to go and register with the ECGC, and we secure yourself and secure ourselves. Because finally, as a forwarder or as a logistics service provider, when we see into this, if you take for an example, FOB shipments, when it comes to shipping these FOB shipments, and that it remains as an unclaimed cargo, where there is no claim for this cargo being done by the consignee, it is very easy for any of the shipping lines and come and back bounce to the freight forwarder or the customer saying that, no, you have booked the cargo, you are levy to the cargo, it is you who is responsible to get this cargo. And then how such type of insurance play a very important role in securing these forwarders also, securing the exporters also. We would like to learn upon that. And hence we look forward to have this session, which can enlighten the members and take some more question and answers, where it can help our members to take the cognizance of it. And surely the question answer, the deliberation will really help our members over here. Thanks, Rajesh and all our members over here. We also have Mr. Tej Contractor here, and Mr. Secretary, Mr. Vinod Sharma ji here, Mr. Nirav Thakkar here, Mr. Sudhir Agarwal ji, our honorary treasurer, who is initiating this insurance and banking in our FFA. So welcome all on the board, and the members, the great participation which we would like to have from all India. We have we also have a live telecast And also, this would be a recording being sent to all the members, to the 7,000 members which are on the board, because it's a 28-member association. So we have these recordings for education purpose also, to know the members as to the importance of this ECGC, and we will surely look upon more enlightening from this session. Thank you, over to you, Mr. Rajesh.
So fantastic, Chairman. This was a fantastic, welcome address, and I'm sure, as you said, I think ECGC should consider forwarders and CHAs also a part of it, and find out some insurance for us also, so that we can also be safe, because we are always on the mid of the sea, where here nor neither there. So I think we should get some good explanation from Shri Anandji also about this, and I think over to Anandji, so that we can hear more from you. We don't waste much of our time on this. Thank you, sir. We'll be.
Good afternoon to all. Good afternoon to all.
Good afternoon, sir.
First of all, I would like to acknowledge the contribution of the association in making the $400 billion export target being achievable. We crossed the $400 billion target last year. So in my opinion, the association has played a very vital role in that. And as we all know, that exports is all about repeat order. So taking that into account, this $400 billion that we did last year, now the target will be to do this $400 billion by December, or maybe earlier also, so that the export can grow in a better way. Because if you look at the overall global trade, then each country is doing import and exports. And as per our country classification list, there are almost more than 230 countries which are involved in export-import. So if you look at it, then what we are doing in export is that we are transferring the asset to another country, and against which payment has to be received. Now, it's a universal phenomenon that there is a product life cycle. Like a human life cycle, there is a market life cycle, there is a product life cycle, and similarly, there is a buyer life cycle. So if I am entering the buyer life cycle in a growth stage, then my payments will be steady, they will be coming on time, and I'll be very happy. Now this growth stage simply reaches the maturity stage, where the payments will start getting extended. DA 60 days or DA 45 days will get extended to DA 90 days. DA 90 days will get extended to 120 days, 150 days. And after that comes the decline. So in the decline stage, what happens is the payment for the shipment will not come. And basic reasons for that are that either the buyer will go insolvent, because if you look at it, then the buyer is not the end consumer of the good. Whatever we are exporting to him, he is simply a distributor. He distributes it in the channel. If the invoice is drawn on DA 90 days, then the cycle is that the buyer will distribute it in the network, and payments are to be realized against that invoice within 90 days. He'll collect the payments and then transfer it to the exporter. Now what happens is, if there is some disruption in that chain, so my buyer may be very good, but if there is a disruption in the chain, then he will not be able to pay me. So we have basically three verticals where we underwrite the risk. First is the risk that is covered by ECGC for the banks, where exporters, they get the order, they go with the order to the bank, against which the bank finances them. So we cover the banks against the default of the borrowers. That is one leg of the transaction. So once, as an exporter, I have got an order and I have gone to my bank and availed the finance against it, I'll process the goods and I'll make the shipment. So then comes the post-shipment stage, against which I'll be submitting the documents to the bank, for which post-shipment finance will be made available to me. Now, in this, if you look at it, then there are two legs of transaction. One is between the exporter and the bank, and the second is between the buyer and the exporter. So for the exporters, we have that we have that cover where they can cover the insolvency and protected default of the buyers. So what happens is, like, banks are all aware, all the banks, public sector banks that are there in India, which are extending export finance to exporters, they are covered centrally on a whole turnover basis. That is, if anywhere in India some export advance is disbursed by a public sector bank, then it is automatically covered by ECGC under its whole turnover export credit insurance for bank schemes. Now, in exports, the default will always occur on the buyer side. So if you are not covered with the buyer, then if you have made the shipment and payment has not come, and post-shipment finance has been availed against that bill, then if the payment is not there, then automatically after some time, as per the chain of events, the account will turn into NPA. So the benefit of availing this cover, credit insurance cover, is that in case, because as we all are aware that the margins are very thin nowadays. 10 or 15 years back, if one shipment got defaulted, then you had a chance to come back again into the market. But nowadays margins are so thin that if there is one default, then the probability of coming back into the market, because the working capital cycle gets affected badly. So in our experience, most of the defaults that take place are on the post-shipment side, where the buyer will default and exporter will suffer a loss. So if he is having a direct cover on the buyer, at least he can lodge a claim with ECGC, get compensated, and whatever bills are outstanding, the claim paid amount can be adjusted against those bills. So the unit remains functional. Because if you look at it, then in a simple way, if we want to increase exports, then we have to increase the exporters. That means the pool that we are having, we have to protect this pool. So one way of doing that is having cover on the buyer, on the ultimate buyer. The second advantage of this is that if you are connected with the network, then if some buyer has defaulted in Chennai and he places order to some exporter in Calcutta, so at least if he is connected with the ECGC network, that information will be available to him, that the payment for some invoice has not been made in Chennai, due to which this company is put into the buyer specific approval list of ECGC. So that means you will have to modify your payment terms to either advance payment or LC. And secondly, what happens is, if you are in Calcutta and you want to do that order, you go to the buyer, you tell him that your name is in the ECGC buyer specific approval list, due to which I will not be able to extend credit to you. So in most of the non-payment cases, almost 60% of the cases, the payments are made by the buyer for the outstanding invoices, so that trade can continue. Because buyers in general deal in multi-commodities. So he may be exporting engineering goods also, he may be exporting rice also, ready-made garments also. So for one invoice of ready-made garments, he will not be willing to stop the supply for other commodities. So in that way, what happens is, we collectively, as a collective unit, if there is a default, because it is a musical chair, default is basically a musical chair. People who are going about the chair, once the music stops, whoever is left standing. So if you are having an order today and somebody is having default, you say, no, the buyer is very good, he is making my payment. So sooner or later, you are going to be in that situation. So in export scenario, we have to address these problems collectively. So in this presentation, which we are going to make to you, my colleague, Mr. Saket Kumar, will make the presentation. We'll be addressing the major points. And the basic, for common understanding of all, is that ECGC cover will come into force wherever there is a contract. So if there is a contract between the buyer and seller, that contract will be underwritten. If there is a contract between the bank and the borrower, then that contract can be underwritten. So this presentation that we are going to make, it will cover almost all the aspects of the direct covers that we are offering on the buyers. And we'll be happy to take the question and answers in the session later on. So I'll hand it over to my colleague Saket to make the presentation. Thank you.
Thank you, sir. It was a fantastic detail what you gave. And in fact, when you said about...
Thank you, sir, for opening the floor.
Right, sir.
I once again welcome the delegates from Fred Federation of Freight Forwarders Association in India, and I also welcome the team members of this association. Indeed, it is a great opportunity to share the main business dealings of ECGC and how the Export Association and its members can get maximum benefit out of it. We'll be going through the presentation. Basically, ECGC was established in 1957, and we are fully owned by the Government of India, functioning under the administrative control of Ministry of Commerce and Industry. It is managed by board comprising of Government of India, Reserve Bank of India, banks, and other industry associations. Across all the major export centers, we have our branches, which is spread in 46 export centers. Apart from that, it is managed by 4 regional offices. We are also a member of Bunny Union, that is basically an international association of credit insurers. And we also manage this National Export Insurance Account on behalf of the Government of India. So far, we have been talking about short-term projects, short-term exports. This National Export Insurance Account pertains to export which are basically executed on long term, known as medium and long term project exports. So there are common risks in export. Anybody who is in export, anybody who is engaged in export activity, there are 2 parts of risk which can be divided into. One that pertains to goods, where the main risk what we perceive is loss or damage to goods. That is generally covered by marine insurance company under various nomenclature of its insurance policies, say cargo insurance, marine insurance, bulk insurance, fire insurance, transit insurance, and all. But when it comes to receivables, we do export so that we can earn dollar for the country. Basically, receivables, that is payment, what we are supposed to get, is also prone to risk. Again, this non-payment risk or this receivable risk is divided into 2 categories. One is exchange risk, where currency fluctuation is being hedged by the authorized dealers, say banks primarily in India, or otherwise forward contracts also are there to make this instrumental. The most important risk, what really create a worrisome for the Indian exporter, is payment risk. This is where the credit insurance come in picture. So ECGC has been established and has completed more than 6 decades as on date, serving the nation on front of credit insurance, serving the Indian exporters on front of credit insurance. So your non-payments are basically being insured under credit insurance policies. And here we are the National Credit Insurance Company in India providing these services. Our mission is basically being an export nation to support the Indian export industry, while we also ensure that the cost is very, very effective. Just for the information, would also like to tell that in last 15 years, there have been 2 downward revision in our premium rate. Alternatively, we have not increased our premium rate for last 15 years almost. 239 countries as on date have been listed where we are providing our credit risk cover to exporter against non-payment risk, which can be arising because of the failure of the overseas buyers or in buyer's country in respect of where export is made. As sir said, we do provide credit insurance to banks where lending risk of borrowers, exporters are existing. So this basically eases the process for the exporters, in turn also eases the process for the banks, because banks, they become liberal while they fund the exporter, provided the exporter is also having the ECGC policy, where the failure of the buyer is indirectly or directly covered. for that, there are internal mechanism. We do underwrite a country first, that where export destination is defined or selected. Apart from that, we identify, we underwrite your buyer, which you have identified. We do due diligence of the buyer. There are certain parameters. It includes financial, of course, and non-financial parameters also. And based on that, a credit worthiness of the buyer is decided. And a credit limit is also decided, that up to what limit an Indian exporter, or put together all the Indian exporter, can take a peak exposure on that particular buyer. Apart from so that they can have primary information before it's login and check that whether buyer appears in this ECGC person list or not. So they will have a free mind to have next round of negotiation whether they should proceed further or not. So country listing is there, buyer listing is there. This make them easy to have business opinion or decision faster. Apart from that, when insurance is there, definitely claims are also there. And apart from claims, sometime recovery is also there. So for exporter policyholders, we also help them in recovering their bad debts. These are the major terms of payment involved in export transactions. The first is, of course, advance payment. Very few items or commodities are identified in India where we can fetch advance payment. Otherwise, letter of credit, again, being the common one, has its own restrictions and has its own risk also. So as far as advance payment is concerned, of course, there is no risk till it goes with 100% advance. When it comes to letter of credit, though letter of credits are irrevocable as on date as per UCPDC, it is either issued on side basis or it is issued on usance basis, let's say 60, 90 or 120 days. But still, default of bank, chances are very, very bright that it can occur. There are so many circumstances which has arisen or which may arise in particular country. Apart from bank's failure, discrepancies, again, it plays a very spoiling role in non-payment. And the most important one is political issue, which we are witnessing as on date. If we go back post Lehman Brothers, we have witnessed that within 6 months of a span, more than 125 banks in US alone, they have collapsed. So if it can happen within 6 months of a span in US, it can happen anywhere. So covering LC is also equally a sound decision as on date when you are into export business. The next terms of payment commonly used by exporter is DP, that is documents against payment. It is also known as cash against document. In this, the most important risk what exporter carries, goods are shipped to the buyer's destination, but it results into non-acceptance because buyer doesn't honor the documents. Goods may lie on the port itself and buyer will not get the documents released, and ultimately it will result into non-payment as well as non-acceptance. Usually it is done sometime with willful intention or sometime with forceful intention. So DP equally is not a safe mode to do the international transactions. Non-acceptance is the major risk which is involved. Next come, which is the most common and popular one in India, because we do keep on competing with all set of economy, all set of countries, say Bangladesh, Bahrain, we keep on competing. So this is the most popular term where we openly offer the credit because it is buyer's market. We are not in a position to dictate, or our goods are not in a position to dictate the terms. So it is buyer's market. We are ready to offer the credit, be it 60 days, 90 days, or 120 days, which is a common trend across all the commodity, across all the regions of India, what we are witnessing basically. And the most, being most common terms, this also carry the most claim occurrence history and potential potential as well, because this gives a chance to the buyer to have a protracted default, a willful default. In case of insolvency also, our coverage is available. Here, this DA and OD, OD basically stands for open delivery transactions. Generally, goods are also shipped by air, that also carry equally risk, because in that case, what happened? The managerial control of the goods, it doesn't lie with you, even if being an exporter, you are holding the original documents. But airport, international airport, generally they release the goods only with a seal and stamp of the buyer, being the consignee. So this also carry maximum risk, because the transaction become completely open and control of the goods, it goes with buyer. So generally, our insurance policies, it cover all the risk what we have dealt in separate terms of payment. And again, broadly, it is divided into two parts. One is commercial risk, which may arise because of buyer's failure, or it may arise because of LC issuing bank. It can be insolvency of the buyer. It can be a protected default of the buyer, or it can be a contract repudiation when goods are shipped on CAD or DP terms. So this is where our policy is covering the failure of the buyer in terms of risk arising because of these reasons. There are certain other reasons also where a buyer can fail. We'll also discuss in upcoming slides. Apart from commercial risk, we do cover political risk, which is very vulnerable as on date. And it's not only as on date. If we see even during Gulf War, when Iran fails basically, or even currency crisis, or even during this US subprime crisis, these risks have been prevailing in industry, and it has been forcing the industry to go on back foot. So basically, political risk, it may arise because of delay or block in payment due to government guidelines, change in certain government guidelines. All of a sudden, there can be restrictions, new import restrictions, or cancellation of orders. It can be again war, civil war, or disturbances, or there can be a coup in that particular country. And because of all these things, a shipment need to be diverted, or ultimately voyage get interrupted. So any sort of political reason because of which your payment is getting blocked, our insurance policies are providing cover for all sort of political reasons when exporter is in difficulty. Simultaneously, we should also tell that what risk basically we are not covering. So first and foremost is this commercial disputes. That is also quality. Basically, it is known as quality disputes, because we don't know what samples you have shown to the buyer and what exactly you have shipped. So quality or quantity disputes, that is commercial disputes, we are not covering. Exchange rate fluctuation, again, since it is hedged by the bank, so it can be covered by the forward contract by the bank, we are not in picture. Failure of the agent, this is very important to understand. An agent is supposed to get the commission, not the payment. So his failure, we are not going to cover. What we are covering is basically your buyer, because legal entity buyer is the one who is responsible to make the payment as per your contract. Agent is only responsible for this commission part. So failure of the agent is not covered in any of the policy. Whatever loss or damage is arising, which is covered by general insurance or any other insurance company, we are not there in picture. And once a contract is signed between a buyer and a seller, you are bound to fulfill the terms of that contract, be it a non-LC contract or LC contract. If it is not fulfilled, we are not in picture. So as far as our products are concerned, irrespective of size of the exporter, irrespective of commodity, products are available for each segment. Let it be a shipment to a particular buyer, let it be a particular shipment one time for a buyer, let it be a shipment for full year to only one buyer, or let it be a shipment of entire turnover. That means for a company, its entire turnover also can be covered. For that, we have whole turnover policies, which is exclusively for small and medium exporters. Again, our policy is broadly divided into two parts. One is declaration-based policies, where exporter, if he offer his entire turnover to us, each invoice will be charging a defined premium. Apart from that, we do have exposure-based policy. Suppose the exporter is having turnover of 10 crore with only one buyer, and he is dealing the buyer on 90 days terms. That means in a year, though his turnover is 10 crore, his peak outstanding may not be arising beyond 2.5 crore or say 3 crore. That is 1/4 of his turnover. In that case, he can have a policy of his peak exposure value, that is of 2.5 crore or on 3 crore, and he can choose to pay the premium for this 2.5 crore or 3 crore, whereas it will be covering his entire turnover of 10 crore. That is one concept. Another concept is where an exporter is having turnover of 100 crores and he is having mixed terms of payment. He does the business on CAD terms also. He offered 90 days credit also. He offered 120 days credit also. He does LC also. And in that case, his overall exposure does not exceed more than 10 crore in a year. In that case also, though his turnover is 100 crore, a policy of 10 crore value can be issued for a year, where put together the claims value will not exceed 10 crore in a year, and per claim again it will be restricted to 1 crore. So it's very simple. 100 crore turnover, minimum policy can be issued for 10% of your 100 crore turnover, that is 10 crore. And again, per buyer it will be 10% of your policy value, that is 1 crore. So we mean to say that all sort of products are there, and it can fit for all size of exporters, for a startup, for a new exporter, for an existing exporter, for a small or medium enterprises, or for large corporates. So this is how we provide cover. So selective to your entire turnover can be covered. Apart from that, we also offer policy for service exports, for service exporters. It is a trend where services are offered by Indian companies to their foreign supply, and invoices are raised for the services rendered. Initially, when this policy was launched, we were basically aiming the software exports. Their service part was involved. That too, it was restricted to IT, because IT-enabled services were the core activity happening in this sector, particularly from Bangalore and Chennai, IT hub being IT hub. But now it is expanded. There are a lot of area. Even you can take the example of this medical medical line, where even trial of medicines. This is also a kind of service which is being extended by a lot of MNCs, pharma companies, and where invoices are raised on a particular period. There also chances are that the invoices raised may not get paid. So service exports also we are providing. Consignment exports, this is providing cover to global entity as well as to stock holding agent. This is also one trend where Indian companies, they are shipping the goods abroad. They can have a tie-up with someone there to maintain a warehouse, and JIT concept, that is just-in-time concept, to ensure that goods reaches once the buyer request for the goods in time. So they maintain a warehouse there. Sometimes they do maintain it with their own company, own group company, or own sister concerns. So they become their global entity. So that transaction, irrespective of whether a warehouse is maintained by a stock holding agent or it is maintained by its own group company, the consignment exports policies are also there to provide cover till end buyer, till ultimate buyer, the transaction get completed. In turn, it also covers the political risk arising in particular country as well as arising in destination country. Because consignment exports is like that. An Indian exporter may be maintaining a warehouse in Japan, but ultimately he must be shipping or he may be shipping from Japan to nearest countries also. So not only political risk arising in Japan, but to the destination country also stands covered in this policy. Same way, stock holding agent, if is sitting in Japan, apart from that, the destination country where buyer is sitting, this entire transaction is covered under this nature of business consignment exports. Apart from that, we are also into factoring, where we are discounting invoices for MSME basically. This is what we have been talking about. Basically, Indian company, they conclude a contract with foreign principals and they provide them either technical or professional services or both type of services. And payment is done either on a milestone basis or on man-hour basis, as the contract says. And in case of failure, payment can revoke this insurance policy and can claim with ECGC. Here again, a specific contract can be covered. Apart from that, entire company's turnover in a year also can be covered. Generally, these are the obligations what we expect from exporter members once they take the policy. Of course, they should ensure that policy is all along the time valid, and maximum liability is nothing but in general insurance it is known as sum assured. We say it maximum liability, that is policy value. Exporter has to ensure that the value what they have taken of the policy is adequate and it is not underinsured. Again, being registered under IRDA, advance premium is mandatory irrespective of type of insurance. Hence, credit insurance also it is very, very mandatory. And e-connectivity, what we have been discussing about the buyers who are already in default due to various reasons. We have already paid claim to them or non-payment reports have been reported by exporters. We maintain a list of all such buyers, and this database is maintained on our website, and user ID and password is circulated to all the policy holders so that they can have access, and primarily they can see whether the buyer with whom they are going to negotiate or dealing, whether it appear in that particular list or not. Exporter need to ensure that with a particular buyer, whatever peak outstanding he is expecting during the policy period, he has taken that outstanding in terms of credit limit. That means proper insurance is available for particular buyer also. This is again B-cell what we have been discussing. Usually buyers who appear in our B-cell, that is buyer specific approval list, we don't provide cover to all such buyers. Because once a buyer has defaulted to one exporter, there's no point in encouraging such buyer irrespective of any terms of payment. Here we would also like to clear that we just say that we don't provide insurance. We never say that you don't do the business with them. It is up to you that whether you would like to proceed with such buyers without insurance cover. The 239 countries what we have been talking about, out of these 239 countries, there are around 20 countries which are placed in restricted cover category. For example, recently we have placed Russia in restricted cover country, but for exporter policy holders, we are providing cover on a case-to-case basis. Again, that cover is provided on revolving basis, valid for 1 year. But of course, in this scenario, exporter has to take a judgment prior to approaching ECGC whether he really need to do export to such country or not. Another obligation is that as per type of policy, you need to submit your statement of shipments, whatever you have affected in a month, by subsequent month of 15 to ECGC. So this is what we have been doing under policy. Now the important part is that how a claim can be processed and what are the documents required. We'll see in this section. So first and foremost thing is that exporter who is expected to get his payment on a particular due date. As per a contract, a due date is defined that buyer is supposed to make the payment, or else the opening bank is supposed to make the payment. In case he doesn't get that payment on due date, first thing he has to do is that he has to file an overdue statement with ECGC. He has to report the overdue to ECGC. And for that also we are giving plenty of times. It's minimum 30 days. Due date, he has to wait another 30 days. And again, in subsequent month, by or before 15th, exporter is supposed to submit the overdue to us. Timely intimation of overdue plays a vital role in restricting the undue or unwanted exposure on same buyer, because it is not necessary that all along only you are the one exporter dealing with such buyer. There are possibility that a buyer exporter sitting in Bangalore, sitting in Chennai, sitting in Jalandhar, sitting in Mumbai will simultaneously be doing business with same buyer. So once you report it timely, we can caution all our member policyholders that this buyer has defaulted, and probably we may be in a position to restrict the further exposure which may not arise once you report it timely. So any adverse development need to be intimated, and that starts with your non-payment arising after the due date has crossed. We were discussing about CAD transactions, that is DP transactions, also known as side transactions. Non-acceptance of goods, that is 1 point. To assign what is the reason that buyer is not in the goods. You have to safeguard the goods, preferably to a bonded warehouse. These are the basic steps. You have to believe in such a manner that nothing is insured, and you have to minimize the loss. So basic steps what you are supposed to take, you have to take as a businessman. That's what we expect you. Then you have to explore the options. And the first and foremost option what we expect to explore is that resale of the goods. For that, you can locate an alternate buyer, either in the same country or any part of the world. As per procedure, you have to serve the notice to original buyer. Now, again, we give discretion to exporters. If your loss basically in this case will be one, the ultimate buyer, the new buyer may be seeking some discount because he knows the goods have been exported to X and now you are approaching to him. He may expect some discount. No issue. So being a business discount, you can close the deal. You can offer some discount. If he's in same country, it's okay. Again, you are reducing the expenses. Otherwise, if it's different country, it may again attract additional freight charges. If all these expenses, that is discount to end buyer, ultimate buyer, and your additional freight charges, if it is up to 25% of your loss is basically your invoice value, you are fine, you proceed. You need not take prior approval from ECGC. Rather, you need to just inform us that this is what has happened, and you claim with us. Once these procedures are completed, we reimburse the expenses to you. If it is up to 25%, if beyond 25%, you take out prior approval, again it is being reimbursed when you lost the claim. But what we have to ensure is, once an overdue has occurred, you're not making further shipment to the buyer. As we said that indirectly or directly, you should not increase the exposure either at individual level or as a company. The next step, what we expect in case resale is not possible, re-import is one of the options which can be explored. There can be so many reasons. It can be commercial reasons because of buyer failure. It can be political reasons because of country issues. Goods are lying in port and either due to commercial reason or due to political reason, you have left only one option, that is re-importation. Again here, if your return charges, this also includes your lorry charges till your warehouse. If it is exceeding 25%, you take prior approval from ECGC. Otherwise, straightway you can come for reimbursement in terms of claim. And the worst scenario which may occur is abandonment. Prior to abandonment, in case of resale or even in case of re-importation, let me very clearly tell you that salvage value of the goods, we have nothing to do with that. What we are covering is, in case of reimportation, is your additional freight charges, that is to and fro freight charges, that's all. Because goods, ultimately, you will have managerial controls and you can sell it anywhere in India. And the worst scenario is abandonment, which usually any insurance company will discourage. But if it is binding and it is the only option, last resort, you take out prior approval. Here, that 25% clause and all will not be applicable, because abandonment means entire consignment is being abandoned. And you have to keep all the documents intact while you are lodging the claim. And the first and foremost important document is that proof of abandonment. It can be a letter in the it can be a letter or certificate issued by authorities such as foreign bank or shipping line or customs authority, or from a chamber of commerce in that particular country. Sometimes we do ask for approval from your banks wherever it is applicable. Acceptance of goods, that is basically for DA, where our GM Sri Anand Singh was also referring that this 30 or 60 days is being elongated. Now it is becoming 120 or 180 days. There are certain cases where buyer may be in a fix. His financial condition may not be stable. He really wants extension. Again, insurance apart, as a businessman, you have to take a first decision that whether you should really grant extension for such bills. If you agree, in principle, ECGC also agree, and we accord extension as per your request. But again, we expect you not to make further shipments, because once we are extending the liability, that means buyer already is witnessing financial turbulence and is not in a position to make the payment. So there's no point in making further shipments when earlier bills remain outstanding. So we do accord extension. Sometimes it may so happen that bill sent on DP, buyer may seek request to convert it on DA, and there may be genuine reasons. Take out prior approval and conversion is considered. Time limit to file a claim is usually 360 days from the due date or 540 days from date of expiry of policy, whichever is earlier. It is basically to mention here. But frankly speaking, once you exhaust all your recovery efforts and you are sure that nothing is going to materialize, you complete the procedure, say reporting of default to ECGC. Then we'll have some formalities in terms of debt recovery with recovery agencies we have tie up. And if all these sorts are exhausted and nothing is moving, you need not wait for 360 days. You can lodge the claim at the earliest itself. There are proper format, prescribed format in which claim need to be submitted. And these are the documents which are required at the time of claim. If you go through the list, these are the very basic sort of documents what we expect an Indian exporter to maintain and to submit along with claim form. Nothing is extraordinary which is being asked from the exporter. A contract or order copy, an invoice, bill of lading or airway bill, non-payment advice from the foreign bank, direct document to buyer. In case if it is sent, we need proof of delivery, that liners basically freight forwarders they give. Or in case it is DA shipments, buyer has taken the delivery, acknowledgement of debt by the buyer. It can be a assurance also, okay, I will pay on this date. That also can be treated as an acknowledgement of debt by the buyer. Original unpaid bill or accepted unpaid bill of exchange. Protest note, correspondence with original buyer. Just because you have taken insurance, you are not supposed to have a comfort zone. You are supposed to keep your recovery efforts intact. Frequent mails, phone calls, or whatever you are supposed to make. So all those documents in terms of correspondence need to be submitted along with claim form. That basically establish your recovery action. Then a statement of export for last 1 or 2 years. This is applicable as per the policy what we have issued to you. And all these basic documents, your bank, whomsoever has handled the export documents, they are supposed to certify all these bank documents. So these are the basic documents certified by your bank to be submitted at the time of lodgement of claim. Certain cases where we pay the claim and recovery is also expected, or recovery is also received by the exporter after certain months or after a certain year also. So as we pay the claim, exporter also has to reciprocate the recovery action with us. He has to share the recovery in same proportion as we have lost. In between, we have debt collection agencies with us, and sometimes we also are ask exporter to proceed legally with the buyer. But again, it is a discretion given to the exporter. It's not mandatory. In case buyer has filed for insolvency, official receiver is being appointed. They will issue generally a list of debtors. Exporter has to submit the claim immediately once he get the debtors letter from the official receiver. And in case of event of realization, as we said, that recovery has to be shared proportionately as the claim was settled by the ECGC. And thank you from my side. Now floor is open to you for question and answer sessions. Thank you.
Sakesh, fantastic. It was a real eye opener for us. And we knew each and every point was clarified so well. And I'm sure we'll have some more questions and answers coming in. And Anandji also clearly informed us about 3 verticals and how it works and what is the main credit cover insurance. And it was quite, it was very big eye-opening for us. And only thing, Sakesh, from my side is that you said risk not covered, in that most of the buyers, the general, what they say is that quality is not met. This is where we have most of our shippers say, like, they do under Bureau Veritas or SGS or all this inspection has been done. And with one single line, they'll say like quality is not matched and that ends there. So is there anything which you can put one step ahead and see that something can be done? And the floor is
open. For that, basically what happens is, what you say is very correct, because practically it happens like that only. But if you take a step back and analyze why it happens, because there will be a demand against which this supply has been sourced. So if the demand is not there, then automatically all those things like quality is not right and some other thing or some certification will go missing. In fact, the classic case of that is LC discrepancies. If you look at the data, then I don't think almost more than 90% of the LCs will not be paid 100%. For a $10,000 LC, the payment will be $9,000 or something like that. $50 or $100 will be deducted from that LC. And LC is supposed to be the most it is the strongest
safest mode,
as an exporter, which safest I will mode. Like to prefer as a mode of payment. Right. But even in that, either $50 or $500 also to some extent, they will be deducted by the foreign banks. Now, why that happens is that every foreign bank or the bank which will be handling the LC, they are having people who will automatically find the discrepancies. And if the buyer wants to make the payment, he'll say that you go ahead, make the payment, whatever discrepancy charges are there, you deduct it. They'll deduct those discrepancy charges and make the payment. Now, if the demand is not there, then automatically that document becomes discrepant and the payment will not come. So we'll transport this situation into the non-LC cases also. In non-LC cases, what happens is, if the document has gone bank to bank, then it will be a DA document against acceptance. And if it is a 60-day document, then the buyer will endorse the document that I'll make the payment on the 60th day. And on the 60th day, he'll come up with some excuse and the foreign bank will pass on that message to our bank saying that this is the reply that we have got from the buyer, and please like sort it out within 7 or 10 days, or we'll return the documents. And after 10 or 15 days, the documents get returned. So if this happens like 1, 2, 3, 4, multiple number of times, then as an exporter, what can I do? So what we advise the exporters is that in the invoice itself, you can make a note, or in the pro forma invoice, you don't want the invoice to be tampered with. You can make a note of that in the contract or the pro forma invoice, stating that any quality dispute or any disagreement with quality, it should be reported within, as per industry practice, 7 days, 10 days, 15 days, whatever time you want. That note should be put there, because apart from the buyer, as an exporter, if there is a if I am making an inferior quality good, because buyer is actually nothing but a distributor for me. So I want the market to be captured. So if there is some discrepancy in my goods or some defect is there, I should, as a supplier, I should be aware. So if there is a genuine like defect and it is brought to my notice, then I'll take care. I'll take care of it. But it has to be reported timely to me, so that I can also make the changes at my end, so that the next supply that goes, it is according to the order. Now, if we are having this line in the contract that this quality defect or this, whatever disagreement was there, it was to be reported within 7 days or 10 days or 15 days. And the defect is reported on the due date, or even after the due date, when we start following up for the payment, that the payment date was 29th or 28th of April. You have not made the payment till date. Please make the payment at the earliest. So after 1.5 months, then the response comes that, because what happens is, once you supply the goods to the buyer also sells it to the ultimate buyers. And they also like $100 invoice will get broken down to $10 invoices, then $5 invoices. So if some dispute is there at the ultimate end, then it gets translated back. So to avoid that scenario, we should document, because in credit insurance or any insurance, the documents must be strong. So in our case, we are very trustworthy people. We Indians are very trustworthy. We go by the word. So unfortunately, in documentation, we are very weak. So if we can just strengthen our documentation part. And on the other side, if you look at the buyer's contract, if you work with the bigger buyers, like JCPenney has gone insolvent last year, and we paid somewhere around more than 100 crore claim on that to different exporters. So if you look at their contract, it will be like 50 or 100-page documents where everything will be very crystal clear. And they'll be having a part where if there is non-compliance on your part, then what actions will be taken against you. So even if we can't make that document, our document, that much stringent, at least some portion should be there. Because as I said, as a supplier, I want to be very clear what I am supplying. You have asked me to supply 1, 2, 3, 4 to 10 points. I have made my supply according to that, as per the specifications. Now, if the payment on the due date of payment, you are telling me that no, that the 3 number point and 5 number point are not compatible. So there is a quality dispute. So that thing should be addressed before, at the contract stage itself. And it should be made clear to the buyer that if you are having any disagreement with the supplier, please report it within the time frame. Because after that, I will not be responsible. Fantastic. So if we do it like that, then our case becomes stronger. I'm talking about as an exporter. If I do it like that, so for ECGC, my case becomes stronger, because if I go to ECGC and I lodge a claim with ECGC, and tomorrow ECGC says that there is a quality dispute being raised by the buyer, there is a you have not made the supply as per the contract, then at least I can quote that my contract was that if any quality dispute is to be reported, it has to be reported within the time frame within the contract. Since this has not been reported within the contract, it is not a quality dispute. It is a bad intention of the buyer and not to pay. Right. This is one aspect. And as ECGC, now I tell you what we do. When there is a case of quality dispute, we look at the history of the buyer. Who are the other suppliers that are supplying to him, whether their payments are also getting like delayed or stuck, or are there any non-payment cases reported against him also? Because as you may have seen in the slide, we are an export promotion organization. Our basic aim is to promote the exports. But we are also registered with the IRDA, and we have the CAG audits, and we are registered under, we sign an agreement with the Department of Public Enterprises also. So commercially, it is a company. It is a company under the Companies Act. So whatever regulations or compliances are there for other insurance companies, as a commercial organization, we also have to ensure that we follow that. So in compliance to that, we have these systems. Like if there is a quality dispute, then we will not be able to cover, because quality dispute per se is if there is a dispute, then that means that it is a failure on the part of the exporter. And this policy actually covers the non-payment of the buyer. So if the reason for non-payment is a quality dispute where there is an actual dispute, because if for the other suppliers the payments are being made timely, and for this particular supplier the payment has not come, and there is a dispute in that, then the claim gets rejected. But if there is a correspondingly separate situation where all the other suppliers are also facing the same problem, then it is a default. And apart from this, at the stage of once you report that non-payment to ECGC, what happens is that it sets off a chain of events. First thing is that the buyer default is reported into the system. It gets incorporated. So whatever covers are there on the buyer, which are available to other exporters, they get a notice that non-payment has been reported. So that information trickles down to the buyer that this non-payment has been reported. Then we on ourselves also report to the buyer that this invoice or set of invoices has been reported as overdue by your supplier or by your bank. Kindly inform the reasons for non-payment of this invoice. So in most of the cases, as I said earlier, that in almost 60% cases, the payments come. They come with delay, but they come. And after that, if there is no response from the buyer, then we also engage the debt collection agencies. And these agencies are basically working on a no success, no fee basis. That means if there is no recovery, no charges are paid. If there is some recovery, then they'll be charging 20 or 15 to 25% is their charge. So if you are having a $100 invoice that is outstanding and the DCA is able to recover say $50. So out of that, if the DCA fees is $20, so sorry, $10, then net receivable to you is $40 only. So your net loss is $60. Whatever the DCA charge is there, that also gets accounted as a loss. So your claim will be for $60 with ECGC. And we cover as a loss percentage, minimum loss percentage that we cover is 80% and goes up to 95% also for some policies.
Nice. Thank you so much for fantastic explanation, sir. And in the meantime, there were some 2-3 questions in the chat.
So you are not audible, sir.
Not able to hear me, sir?
Yes, we are able to hear you, Rajesh bhai.
Okay. So there was 2 questions on the chat box and it was answered by Mr. Saket. So that's okay. So any other questions, or I'll leave it to the chairman to have us word and then give it to Vinodji.
Yeah,
Rajesh sir, your voice,
Mr. Vipin Vora.
Rajeshji, you are not audible, sir.
In fact,
You able to hear me?
Yeah, I can hear you.
Yeah, now
No
it is
issues.
coming.
Okay.
Yeah,
Okay. So there was 2 question answer questions which Saketji answered. So that is clear. So if anything, any other person has to have some, they can raise their hands, have a question, then I'll give it to the chairman for his final words and then leave it to Vinodji.
We have Mr. Vipin Vora.
Oh, okay.
Who would like to ask question. I will just request Mr. Vipin Vora to please raise his, please come on board. Mr. Vipinji. You need to unmute, Mr. Vipinji.
Can you hear me now?
Yes,
Yeah,
yes,
yeah.
Vipinji,
Please.
yes.
Mr. Singh, thank you very much for the, things
No
which you
problem.
told us. Basically, we are freight forwarders and custom brokers. We are not exporters. We do not get any order from any importer or anybody. Now, what we are looking at is, we are the service industry. Now, whatever you have exported, as an exporter, the guy who's making goods and who's exporting goods out of India. Now we are in service industry. We are not manufacturers. We are not doing any manufacturing. We are just, handling the shippers, exporters' cargo. Now that involves the freight charges, and a lot of times we have to raise bills to the overseas agents. Now all these overseas agents, they're not registered with ECGC because it's the only importers as well as the exporters are registered. ECGC they don't have any registration of the foreign freight forwarders or foreign custom brokers. Now that is where the problem is. Now, if we have, and plus we do not have a contract with them. I'm sitting in my office today. I just get a message from my overseas agent that, look, this is 2-ton shipment. Can you handle this for me tomorrow? Pick up the shipment from XYZ exporter, handle it, consign it to me. Now, when I consign the goods to him, I have to raise invoice to him for my freight charges. So freight charges is at risk. Now, I have to cover my risk. I also earn the same dollars what the exporters earn, while exporting the goods. Now, if I raise the invoice to him, there is no contract. Only there is one agreement in a year or, for permanent that he'll make payment for January payments. He'll make payments by end of February. Now, there is no individual contract for every shipment. It's all, ad hoc basis. And then the invoices are not that big. There are small invoices also, $200, $500, $5,000, even $10,000. Number of invoices are much more, than as compared to the exporters because their value is much, much more. Now, that is where in the service industries, I personally, my company, Continental Carriers, we have been talking to, ECGC in Delhi. We have given them certain cases also in the last 1 year. This is how we do business, and this is what, why we want to cover. Because I, as a freight forwarder, I don't know about others, I get $2.5 to $3 million foreign remittance every month. But these are all uncovered by the risk. There are a lot of agents in South America who went bankrupt. I didn't get the money. There is no GR1, there is no invoice, there is nothing, no document which I have to give it to the bank. It is only my invoice which is raised to the overseas agent, which I have to collect from him. And that's what we want to cover with the ECGC policy. Now, maybe I have a past performance with them. Maybe I don't have a past performance with them. There are certain groups like WCA and all who cover those, certain risks. But end of the day, we as a freight forwarder, we would like to cover ourselves with ECGC as per your policy in the service industry, not as a manufacturer or exporter. So how we can go about it? That's my question.
Adding to Vipinji's question, we as a freight forwarder doesn't have 7 or 8% or 10% margin.
Yeah.
So our margin is also very small.
So it's basically a service industry, how to cover the service industry. I know manufacturer is something different. They have quality issue, they have every other issue. But as a service industry, how we can cover ourselves with ECGC that our money is safe?
I'll address that, sir. There is a primary contract between the exporter and the buyer, under which this freight forwarding service is being extended. So, and if there is a non-payment on part of the buyer, then ultimately there is a higher probability that the freight invoice that you have raised, they may not get paid.
No, sir, Anand, sir, let me interrupt you here. In this case, I am only concerned with my agent. He has to make a payment. His contract is, if he is giving credit to the overseas customer, it's his responsibility. I am billing him. His responsibility is to pay me, the foreign agent, foreign broker. Now, whether he's offering credit to the ultimate customers or not, That is his responsibility. In my agreement,
So,
it is
Vipinji, let us hear out Mr. Anandji, and then we will
Yeah.
come on.
clearly
Yeah,
written.
Yeah.
Let us first hear out Mr. Anandji. Yeah, he has understood.
our
all this.
basically our problem is that there must be a I code number. So if there is a I code number, then we can create a code for your entity under which we can issue the policy, and offering a cover on those entities with which you are having regular business will not be a problem, because they can be covered, because if the invoice is getting raised, and whatever you said about the order being finalized over phone or over whatever communication, ultimately it is an order that is being converted into an invoice, because based on your discussions, the invoice gets generated.
Yes.
So what you can do for records is that once you have discussed with the other party, your buyer, and you have raised the invoice, you can send it to the invoice, that invoice to the buyer, saying that as per our discussion, this is the invoice that is getting generated. So that is a record for the order part. Now, if there is a non-payment, then ultimately the invoice will stipulate what is the due date of that bill, at what time it has to be paid.
Yes.
And rest of the things will follow as per the merchandise export, whatever we are having, the process will be the same. If there is a non-payment on the due date, then it has to be reported, or the bill has to be extended. If the payment has not come as per the timeline, if the 60 days, this invoice is drawn on 60 days, and the payment has not come on 60 days, then it has to be extended either to 90 days or 120 days, whatever is the mutual agreement between the buyer and the seller. So basically, if you are having a I code number, import export code number, then there is no problem.
So we do have
Sir,
IEC code number, but the problem is that
Vipinji,
whenever-
can I? Just 2 minutes. So I'll just explain this in a small words. Let us keep these two entities separately. One is the importer and one is the exporter. Now we are the industry who serve these importers and exporters. Now, when we serve these importers and exporters, it is we who sometimes have to invest money for them, or we have to take our guidance from our agents at destinations to invest money for them, or we have to recover from there at a later stage. Now, what happens? Sometimes and the freight prepaid, we intend to pay on their behalf. Now, exporters and all, they receive the payments from the importing country, but then it is sometimes they fail to pay us. That is one part. Sometimes in failure of they do not make us the payment because they did not receive the payment due to some compliances or due to some cargo issues or something of that sort. Under that also, what we would tend that at least when we are the member of ECGC as a logistics service provider, irrespective whether the exporter receives his payment or no, irrespective whether what is liable under his policy is a different matter, but under our contract, we should be eligible to receive our payment to the ECGC, and we should be able to cover ourselves to the level of the freight level,
Yes,
the
sir.
extent of the freight level. That is one aspect. Second thing, when we are working as an agent to agent, like we have our partners working in different countries providing the services to these importers and exporters. Because sometimes when we have to import also, export also, it is our partners who are in the better position to provide good freights for the export purpose also, and sometimes good freight for the import purpose also. So in this case also, we tend to invest funds for these importers and exporters. Now, to secure these funds, to secure these freights from the importers, we do extend the credit, but to secure that, we would looking forward to some model where the ECGC can come forward and support our logistics industry to provide this credit for this to the extent of the freight. So that is where we are looking for.
We can examine the cover.
Yeah.
Yes,
So
yes,
Vipinji,
we
you
can
can
do
give a
that.
write-up. Ajayji,
Yes, yes.
what you can do, we have Mr. Rajeshji who is also, and Mr. Sudhirji is also there. We will do a write-up.
I'll just
Yes, sir.
give my requirements. One is that write-up, since you have been, I think, following up this case for more than 1 year, I think.
yes, more than 1 year.
So we can, right,
Yes.
so more than 1 year. So whatever issues are there, whatever literature or write-ups you have shared with our office earlier, forward those also, because they'll be there at our end. I'll just get it examined that what are the issues where we are having this problem gap.
Fine.
So
Fine.
I'll sort out then those issues and then we'll come back to you, because
That's fine, sir.
we are agreeable to issue cover on this sort of transaction. For the exporters, what I meant to say was, if you are not having we are not providing the cover to the exporter, then today, whatever loss he has suffered, he'll go out of the picture. You will be compensated, but there will be no exporter for you to do business with. So it will be better if we can, as an association, advise our exporters, whoever are your customers, that go in for the ECGC cover, whatever sort of cover they want. We have contract-wise covers. If you want to cover only a selective contract, that cover is available. If you want to cover only those buyers, if you are having 10 set of buyers, you want to cover only 2 buyers, then also that cover is available exclusive to the buyers. If you want to cover the whole of your business, because the day you carry the umbrella, it will not rain, and the day you don't carry the umbrella, it will rain. So if you want to cover the whole turnover, because that way the premium comes down actually. If you are covering the whole business, then the premium comes down and the percentage of cover goes up. So ultimately that the benefit gets realized once you have the claim. When you
So
are
basically
in a
what
claim
happens,
situation,
what happens is the main issue which they came up was that these foreign agents to whom you are consigning the goods, they are not approved
Yeah.
by ECGC. Now, if I get a shipment today, it will take you a week or 10 days because they are not in your approved list. Now the shipper doesn't
No, no,
want to
for
hold
that-
the shipment for 24 hours
that,
even.
if you look at the multi-buyer exposure policy, then it is a policy where your whatever turnover you are having. Suppose your turnover is 10 crores, for example, then
Right.
the policy will cover up to minimum 10%, that is 1 crore. And
Right.
10% of that spread will be automatic on all buyers.
Right.
So if 10 buyers default for 1 crore, 10 crore claims maximum you can get. So if you want to increase the exposure, you can increase it. But
Right.
minimum cover will be approximately 10% of the total turnover.
Okay.
We
That's fine.
have understood it.
I'll send you all the
Vipinji, what we
papers.
can do, we will create a model for this to make it
Yes,
a better
yes.
understanding. And then we will give a proposal from our federation. So how
Correct.
we can be secured in a better way of logistics to the extent of the freight which is invested on behalf of exporters, importers. We have additional, we have one with number, mobile number 9843292276. I don't know if, and Mr. Manikanda. So last 2 questions we'll take and we'll cover it also. One second. Yeah, we can have them. You can have a question.
Sir, I have one question.
Mr. Manikandan.
Yeah. Sir, almost 50% for some products, we are contracted for exports delivery for some buyers. So almost 50% of the cost of the shipment paid by the forwarder. So when you are mentioning about factoring, is there any way we can forward us when we invoice to overseas supplier, we can get factoring if we are having some any provision is there?
No, what we will do is, since this Mr. Vora has put in his time and energy for the past some time in this policy cover now, once we get through this policy cover, then rest of the covers will fall in line automatically, factoring included.
Okay, sir. Thank you, sir.
So we'll try to do this policy cover at the earliest. Once we receive the documents from Mr. Vora and the write-up, we'll try to analyze what best we can offer and how we can resolve the issues that are outstanding for such a long time. And definitely from the discussion that we had today, I don't see any problem in covering the transaction. Thing is that the volumes will be more and per invoice the value will be lower. Only thing that is there. So we'll come up with the exposure product which can cover your requirements accordingly.
Fantastic, sir.
Yeah.
Thank you.
We also have on the panel Mr. Tej, Mr. Nero, and Mr. Sudhirji. Anything from your side? Or else we can request Mr. Vinodji to. Yeah. Okay. Would you like to sum up, Rajeshji, or we'll give it to Vinod Bhai?
We'll give it to Vinod Bhai. We'll give it to Vinod Bhai.
No, yeah.
Yes, sir.
Okay,
Okay,
so
sir.
that's once again, thanks from our FFA side also for considering this platform with the joint collaboration with FFA, and we look forward for greater cooperation and greater coverage on this ECGC. Thank you. Sir. Vinod.
Thank you.
Yeah. Thank you, Chairman, sir. Thank you very much. Rajesh ji, indeed, thank you very much for leading from the front and organizing this event for all our members. And Chairman, sir, thank you. We are indeed as a custom brokers, indeed a link between exporters and ECGC. And I appreciate, thanks, Anand ji, that ECGC is very important, and we in documentation are very poor. So we need to educate our exporters, right? So this session is very helpful for us as a custom broker and all participate for us. Thanks for serving for last 60 years. And there is always a risk, except in advance payment, whether it is LC, whether it's DP, whether it's CADs or OD, and very well explained by the Saket ji, various types of defaults and when the risks covered or not covered, what are the mode of say dues for the policies for the exporters, right? And non-acceptance of goods, what we should do, explained very well, sir. And you are covering 80 to 90% risk for the, and most important, thank you very much for not increasing the premium rates for last 15 years. Yeah, that is most important for the all our exporters. And I thank everybody present here, Tej bhai, Sudhir ji, Nirav ji, and all my participants. And special thanks to Saket ji and Anand ji for taking out a special time and giving us insightful knowledge, sir. Thank you very much. Thank you all, sir. Thank you very much.
Thank you so much, sir. It was a wonderful knowledge day for us.
Thank you, sir.
We'll be in touch, sir. We'll definitely give a lovely proposal, and we'll await some fantastic results from
We
you
can
to
have
start with.
more such discussions in future also.
Sure.
This was just an introductory sort of session which we had. Now we can advance it to, because once you go back to the market with the, like, discussing with the exporters on taking the ECGC cover, maybe some queries will be there from their side so that we can resolve it, because you and I both are part of the same ecosystem. So if we are able to support the exporters, whatever they're, because they are having a lot of, their plate is full actually, exporters' plate is full. So they don't basically realize what is the importance of which scheme or which, what is the solution that can be offered to their problem. So once you have understood it, you can at least make them understand if there is any issue, we are there. And we'll be sharing our service network details with you. You can pass it on to your members also, so that whatever is the nearest branch office, exporters can visit that office. Maybe they can discuss what type of cover they want. So definitely once and of course your cover, once it comes to us, then we'll definitely examine it. Thank
So
you.
why can't we look at a collaborative model where we work as an agency in collaborating the things, and there is something benefit to our members given with regard to the getting them on the board? You know, something of that collaborative model.
It can be done, but there are, I think, IRDA regulations. We'll have to see what the regulations say. If the association is allowed to do this commercial activity, then it's okay, because we wanted to do it through the export promotion councils, but their article of association did not allow it, because TDS and like GST components were there. Taxation issues were basically there, due to which we could not proceed further. But if you are willing to do it, then it's fine by us. We are also.
We'll look for a model, sir. How we can it helps benefit members also and ECGC also to get more and more exporters on the board.
Definitely.
Yeah? Thank you, Rajesh. Let's start working on it.
Yeah, sure.
Yeah.
Okay, then. Thank you so much.
Thank you, sir. Thanks.
We'll see you again soon, sir.
Yeah,
We continue to do this initiative.
Yes. Thank you.
Thank
Thank
you
you,
so much.
Saketji. Thank you, Anandji. Lovely. Thanks, Shankarji. Bye.